We know that there's a lot of uncertainty in the world right now, and particularly with the markets, which tends, depending on the day, to get a lot of volatility. If the Fed says one thing or another Fed head says another, how great would it be during this time to have a low-risk investment with steady income? This fantasy might just become reality because today's Countdown closer says he's got the name of an ETF, an exchange-traded fund. He says does just that. Joining us now is Vitafi Head of Research, Todd Rosenbluth. Todd, it's an ETF that I want you to explain to our viewers how it works.
Sure. So JP Morgan's Equity Premium Income, or JEPI, J-E-P-I, is one of the ETFs that we're highlighting on our ETF Trends platform or through Vitafi. This is an ETF that provides stock exposure through defensive equities, lower risk equities, but then uses options, covered calls, to be able to augment that income. So you're getting a steady monthly stream of income. It's yielding consistently about 9% since it's come to market. This is an ETF that is just over 2.5 years old, and has $13 billion. It's actively managed, so you get the benefits of the stock picking, you get the benefits of the ability to take those options and actively roll those forward on a weekly basis in a staggered way. JEPI is a great ETF for investors to take a closer look at.
Yeah, we looked at some of the top holdings there, and there are some big tech names in there, which is interesting. Right here on your screen, it's got Intuit, Microsoft, Accenture, Alphabet, DTE Energy. So a mix here. You just said, so most ETFs are not actively managed. This is actively managed. What am I paying for that? The fees.
So You're right. So people tend to think of actively managed ETFs as you pay a premium. The expense ratio is just 35 basis points, and this is the largest of those actively managed equity ETFs. So you get the benefits of that stable income, but not paying a lot of money. Most, as you mentioned, most of these dividend-oriented ETFs, for example, SDOG, SDOG, which is an ALP sector dividend dog ETF, that's going to be index-based. You're going to get diversification, but you're not getting the security selection. You're just getting the highest yielding companies across all of the various sectors. And we're seeing at Vitafi that advisors are coming to us looking for income alternatives, given the rising interest rate environment, given the fact that bond yields have climbed higher. They're looking to ETFs like JEPI and SDOG as alternatives to traditional fixed income.
Right. And again, the yields are meaty here. I mean, SDOG is more than 3%, and JEPI is more than 9% for the yield here. Yeah, close to 4% for SDOG. Todd, we've got about 30 seconds left. As you look at the markets and the overhang of the Fed concern, the ETF performance, what is the positive for putting money into a basket of stocks versus an individual one?
Yeah, you get the benefits of diversification with an ETF. So we touched on two of them, that you hold companies across various sectors from an income generating standpoint, instead of having to get individual companies where, of course, the dividend could be cut or not grown, or the valuation could climb higher. So diversification is key.
Thank you, Todd. Great to have you. Todd Rosenbluth. And speaking of climbing higher, look at the Dow, now up 194. We are hearing the closing bell ring.